Good afternoon, everyone. On behalf of Columbia University, and particular our master's program in wealth management, it is an honor to welcome you all to this, our 14th speaker series event, where from time to time, we have industry thought leaders come and share with us their perspectives on our fast evolving wealth management industry. Very much in the spirit of the series, our focus today is on the history and evolution of wealth management. And my name is Philipp Hecker. I'm a senior advisor to Columbia, and I'll be your moderator today. In terms of housekeeping, this webinar is being recorded, and yes, you can enjoy a replay later on the Columbia Wealth Management website. Before I introduce our very special guest who will really bring this topic to life, please allow me a few short words on the Masters in Wealth Management program, and let me give you a brief overview for the arc of today's conversation. Columbia University's Masters in Wealth Management is a 16-month part-time online program that prepares experienced and aspiring wealth management professionals to meet all the challenges and opportunities that our industry provides. It is the only Masters in Wealth Management offered by an Ivy League institution, and it also prepares our students with all the educational requirements to attain the CFP, the Certified Financial Planner designation. Should you wish to learn more, simply type Columbia University and Wealth Management into a web browser of your choice. And I would be remiss not to inform you that applications for our next year cohort, starting in the fall of 2026, are still open. The application deadline is May 1st. With respect to the arc of today's conversation, first I'll introduce our very special guest, Mark Tibergien. We will then both share some slides on the history of wealth management, and based on that background, Mark will then dare to take a look forward and will discuss the all-important implications for the talent in our industry for you out there on the lines. Finally, at the end, we'll do an open mic session where our students and the entire audience can field questions directly to Mark. Ask me anything type of style. To do that as we go along, please use the Q&A box at the bottom of your screens to field your questions. And with that, it is my great pleasure and privilege to introduce our very special guest for today, Mr. Mark Tibergien. I'll be a bit more extensive in my introduction than usual, not just Mark to make you blush, but also more importantly, to give our audience a feel for the depth and breadth of your background and your perspectives. In case you don't know Mark yet, he started his professional journey as a journalist and radio reporter in Michigan and gained first exposure to financial services writing for the trade magazine Investment Dealer's Digest in Chicago. And then he really entered our industry, Mark, if I recall correctly, in 1983 as a strategy and valuation consultant and trainer at the boutique firm Management Advisory Services. By way of a merger, he joined CPA firm Moss Adams in 1994, leaving it as a principal in 2007. During that time, Mark is really credited with driving and professionalizing RIA and broker-dealer benchmarking studies in our space. After that, he joined BNY's Pershing Advisor Solutions unit, which he led for many years and highly successfully as CEO until 2020, all while publishing influential columns for the Think Advisor magazine. Mark currently serves as advisor in residence at Ernst & Young, and by now he has consulted to hundreds of companies all around the world. He has authored 4 books focused on business strategy, practice management, and firm valuations and transitions in wealth management. And lastly, Mark, I was lucky enough to be in the room when you received wealthmanagement.com's first Lifetime Achievement Award for your many contributions to the industry in 2024. That was a mouthful, but well-deserved so. Mark, welcome. Looking forward to spending some time with you.
Thank you. I never thought I'd be present for my obituary, but I appreciate the introduction.
There we go. With that, let's get to know you even better as a thankfully alive person. Some quick and short icebreaker type of questions, looking for quick and short answers just to get to know you a bit better. Where are you dialing in from today?
I'm in Seattle, home of the Seahawks, Super Bowl champs.
Excellent, excellent. What brought you to Seattle? Why that choice?
Well, there was a gap in the introduction. I actually was recruited to Seattle from Chicago to work for one of the early registered investment advisory firms that managed stocks that were headquartered in the Pacific Northwest. And the owner was also a specialist in business valuation. So that was where I was taught the fundamentals of business analysis as well as valuation analysis.
Excellent. Thank you for sharing that. In terms of your favorite books, fiction, nonfiction, what's dear to your heart?
Well, I read across the board, but I would say that a book that I constantly reference is called "Lend Me Your Ears." It's by William Safire. It's all about the greatest speeches of all time. So it's something that I often refer to because these speeches are truly inspirational. But among the most recent ones that relate to this industry, there's one by Bob Veres entitled "Behind the Scenes." It's a history of the financial planning profession, and for anybody who's truly interested in where this business has evolved over the last 50 years, it's a great documentary of all that's transpired.
Excellent. Lend Me Your Ears by Sapphire and Behind the Scenes by Veres, two wonderful recommendations. Staying with recommendations for a minute, what kind of podcasts, if any, do you listen to keep abreast about our industry?
Well, I'm fairly random about the podcast, but there are a couple of people that I do pay attention to. Matt Sonnen, who is an executive with a wealth management firm, he has one called the COO Roundtable. Since my passion is truly around the business of financial advice, I find that his podcasts are really quite compelling. Obviously, anything by Michael Kitces is going to be at the top of my list. He has one with a fellow by the name of Carl Richards called Kitsis and Carl. That's a very compelling and covers a broad range of topics, but in particular around business management. And I would probably say when I'm dipping into the advice part of this, I especially like to listen to something called the human side of money. I'm especially intrigued by the emotional connection that the profession has to individuals. I think it's more of a about choices that people make rather than the money people make. So I'm intrigued by those sorts of ideas.
Three wonderful recommendations on the podcast front. Thank you. Last icebreaker question. If you could invite three guests over for dinner, dead or alive, who would that be? Who would you like to break bread with?
Well, now there's a great question. This might seem a little too easy, but I've always found Winston Churchill to be a funny man and an insightful man, not always a correct man, but it certainly might be entertaining if I could understand what he said to have him, although I think he's a voracious eater, was a voracious eater too, so that would be challenging. Um, Second, I probably would want to have another dinner with my father, who's been long gone, because he was a wonderful storyteller. And I think including him in that discussion would be truly terrific. And I'd have to think about it, but I think I'd have to contemplate a musical person like a Duke Ellington or someone from the jazz era, just because it's something that fascinates me, and I always appreciate the way people can relate stories to music, and so someone from that era would be truly important.
An inspiring group of very different characters would be fun to eavesdrop on that dinner conversation. Thank you, Mark. Wonderful to meet you that way. Stay tuned because now we get nerdy, we geek out on the history of wealth management. I'll kick us off by focusing a bit on the ancient global origins leading towards the US, and then I hand over to you. You'll really drive it home from your rich experiences in the US and globally over the past 50 years. With that, I will screen share, and I hope that you all can see a blue PowerPoint presentation building up. That seems to be the case. Let's start with a global lens when it comes to the history of wealth management. Many observers trace the roots back to Europe in the 15th, 16th century, where in particular the Medicis in Florence, the Fuggers in Augsburg, and other merchant families amassed massive wealth that needed to be managed. So family-specific wealth management in the 15th, 16th century, Medicis, Fuggers, Florence, Augsburg, by many accounts, the origin. That business of managing massive family wealth in a way got professionalized in England a couple of hundred years later, 18th, 19th century. The London private banker became a real profession, serving the needs of the crown and the landed gentry, and doing so explicitly across the balance sheet. So in many ways, what we understand wealth management to be today really originated in England in the 18th and 19th century. Keeping that global lens in terms of oldest firms out there, they naturally come from Europe, given what I shared earlier on, Italy in the 15th century, Germany in the 16th, Berenberg supported the merchant families of the Hanseatic lead. And then in the UK, Charles Hoare, the oldest institution still alive today. Next time you find yourself in London, perhaps swing by 37 Fleet Street, where you can literally touch their old building. Keeping the global lens in South America, Banco do Brasil, 1808 is often accredited as the oldest institution there. And in the Philippines, it's the Bank of the Philippine Islands, 1851. With that global background, let's zoom in on the US, where wealth management as we know it today in many ways was born out of the Industrial Revolution, where the robber barons or the captains of industry amassed incredible wealth that needed to be managed. Carnegie, JP Morgan, Vanderbilt, Rockefeller, whose family office was founded in 1882 and is still alive today. In terms of oldest firms in the US, here's a quick overview. Mark, one of your former shops, BNY, 1784, obviously linked closely to Alexander Hamilton. State Street got its origin in 1792 as Union Bank in Boston. On the insurance side, New York Life traces itself back to 1830. US Trust on the trust side, 1853. Bessemer, 1907, tied in many ways to the Carnegie wealth and, Carnegie Steel as well. And then household name Merrill Lynch, 1914. Those just some of the earliest US-based firms. In terms of the growth of the industry, here are some recent perspectives. Since 2000, the wealth in the US, according to the Federal Reserve Flow of Funds study, grew from 43 trillion to 160 trillion. It quadrupled in just about 25 years. At the same time, the professionally managed money 3.5x'd from 20 trillion to 70 trillion, roughly half being institutionally managed, roughly half being retail, individual investors. Incredible growth in our industry from a wealth and managed asset point of view. At the same time, though, the number of financial advisors stayed roughly flat. It hovers around 300,000. That will create some of the tensions and opportunities that we'll discuss in the later part of this conversation. I want to leave you with two lenses of the evolution of our industry. The first one is regulations, and the second one is innovation. We're sharing regulatory developments here because they are so important. They shape our industry in so many ways. So buckle up for a speed walk through key regulations in the US impacting our space to this day. Our journey here starts in 1911 when first state-level registrations of securities and their salesmen emerged. Think of it as the first form of investor protections in our industry. After the crash of 29, obviously regulators reacted. 1933 saw both the Securities Act and the Glass-Steagall Act, which really impacted our space in very meaningful ways. 1934, the SEC was founded, providing oversight for brokers, exchanges, and market conduct. In the 40s, two key regulations came out, the Investment Company Act of 1940 and the Investment Advisors Act of 1940. Both provide a foundation for governance, disclosure, giving us pooled vehicles to work with, and the first basis for fiduciary duties and real wealth management was born. Then we had a bit of a break until the 1970s. ERISA, the Employee Retirement Income Securities Act, laid the foundation, the framework for private pensions and 401k type plans, which are such an integral part of wealth management today. Those regulations were then driven further home, were expanded in the 80s and 90s on the tech side, expanding IRAs and 401ks and really helping the industry shift from DB, defined benefit, to DC, defined contribution plans, in many ways putting individuals in charge of their future. In the late 90s, we had GLB, the Gramm-Leach-Bliley Act, which repealed Glass-Steagall, the separation from 1933 between investment banking and commercial banking, and thus the integrated financial services firms that we know today were born. We also had in 2000 Reg FD, Financial Fair Disclosure, which got rid of selective disclosure possibilities and leveled the access to information between institutional and retail, investors, thus democratizing and providing some degree of investor, protection that way. Patriot Act in 01 and Sarbanes-Oxley in 02, likewise focusing on KYC, know your client, AML, and anti-money laundering, and tightening disclosures and governance even further. We're coming towards the end here with Dodd-Frank in 2010, which reacted to the GFC, the global financial crisis of 08. We saw Reg BI, Regulation Best Interest, about 5 years ago, and today regulators and the industry are finding their footing, beginning to find their footing around cryptocurrencies such as Bitcoin. Those some key regulatory events that shaped our industry. Let's end this little walk with a focus on technology and innovation. Starting here in 1918, the FedWire emerged, a proprietary telegraph cables throughout the US connecting all 12 Federal Reserve districts and via Morse code moving money as opposed to having to do it physically. The first mutual fund was invented in 1924, the Massachusetts Investors Trust. Mainframes emerged after World War II, leading to faster and better record keeping and accounting, thus helping to scale investment management. The first money market fund emerged in 1970, giving us advisors a better means to manage cash. The Federal or the Reserve Fund is still around today. NASDAQ emerged in 1971 as the first electronic stock market driving efficiency and trust. We also saw the first index mutual fund in 1971. The 70s and 80s, discount brokers emerged, Charles Schwab, for example, making markets more accessible to retail consumers. The 80s saw the emergence of desktops, which obviously spread computing power upskilled functions, and helped smaller firms scale. ACATS, Automated Customer Account Transfer Service, was launched in 1985, making the movement of money between accounts and firms so much easier. 1993 saw the first ETF. State Street launched the S&P 500, still one of the biggest today. The 90s saw UMAs and online trading. UMAs are unified managed accounts, allowing an advisor to manage multiple vehicles in one account. And online trading, remember E-Trade, Ameritrade, again provided access to the markets. In the early 2000s, CRMs and financial planning systems emerged. Q marks comment from earlier on around the interesting Veres book. Robo-advisors hit the scene in 08 and 10, and now we're in the era of blockchain and crypto that is really taking off as of the 20s. Agentic AI is the last piece here on this little list. Just recently, the Hazel shock that the industry experienced is one good example. I'm sure we'll discuss all of that in our future chapters. I pause here with that initial grounding in the global background and two key lenses on the US industry around regulation and technology, which are obviously big drivers. And I'm also handing back over to Mark to add his perspectives and comments and remarks and really add color by sharing from your rich journey through our space. Mark, back over to you.
Great. Thank you so much. Very much appreciate that, Philip, and thanks for the background. Are you able to see my screen okay?
Yes, we can.
Great. Perfect. Well, I think that the history that you shared, Philip, is great context. There are elements that I want to refine around some of the points because what's always interesting to me when I look at the business of financial advice, frankly, any industry, is what were the catalysts for change and how does this inform future decisions? So I think for the participants in this meeting today, how you internalize this and how you think about strategically what this means for you and your businesses and your commitment to wealth management as a profession or as an industry can very much be shaped by some of these elements that come into play. When I was asked to participate in this program, I started to reflect on the 50 plus years that I've been around this business, which by itself is shocking to me to think that I still remain active in a business that is going through such dynamic change. But I have to say that there have been times in my life when I have been wondering why that the business of financial advice, which I've always known to impact so many lives, has somehow struggled to attract talent and in some ways is held in low regard when in fact it's one of those careers where it's intellectually stimulating, it's financially rewarding, and as I mentioned, it profoundly impacts the lives of so many. And a recent statistic that was shared by a study showed that there were more people leaving the brokerage part of the wealth business than were entering. And that was really a function of age. So clearly there are many people who are choosing other careers other than wealth management. And that by itself is disturbing. And you have to ask, why does this occur? We also found, though, that while consumer sentiment is muted, which I'll talk about in a moment, and that students are shifting their career choices to things like PE or technology or venture capital away from wealth management, that we do see this other shift that's occurring. It's true that in the broker-dealer world in 1970, roughly around the time that I started, there were something like 6,000 broker-dealers in the US. Today, there are 3,500. But what's interesting, in that same year, around 1970, there were only 1,000 registered investment advisors. And today, what we find is that there are something like 15,000 plus registered investment advisors. And so I'll go through in a moment some of the other transactions that are occurring, but it's quite interesting how this is affecting the business. So as I think about this, I say, what what is really causing all of this to change, and what have we really seen in terms of this evolution? I think as I reflected on this history, what occurred to me is when I began in this business, it was comprised mostly of professional sellers where individuals were paid on a grid. And in fact, back in the day, I would say that most of the brokers were really focused on selling. I call it proprietary products, but in fact, they were focused mostly on U.S. stocks and bonds. So it was a very, very narrow focus, individual securities. And even though modern portfolio theory was introduced in the early 1950s, I would say that most of the brokers that I met during those days were picking stocks and really getting concentrated positions in those stocks. So modern portfolio theory was not really the rule of thumb that we were seeing. It was more of a volume game that happened. Over time, what we found was that with the elimination of fixed commissions, this whole movement towards independent contractors where people could create their own business changed. And we saw this sort of a hybrid evolution occur where we saw professional sellers, they were paid on a higher grid, but they also were business owners. They weren't employees of captive brokerage firms. I think the most significant shift, though, happened, you alluded to with the 1940 Act of the creation of the registered investment advisor, but they were mostly institutional money managers. And it wasn't until later, which I'll show you, that we saw this retail RIA concept evolve where the fiduciary advisors were working with individual clients. And the way in which they charged was different. It wasn't a high transaction cost, which existed in the 70s with the before negotiated commissions were introduced. But so the way in which clients paid were mostly on a fee, usually an asset management fee. But the individual practitioners were paid a salary and a bonus, and they had a wider access to financial institutions or to financial solutions that really changed the way in which these advisors did their business. So all of this is interesting when we look at how this business has evolved, in particular over the last 50 years, because we see this shift from the old captive firm dominance to the new business models, the independent contractor, broker dealer, the trust company, the financial planning practitioner. And what's significant about these drivers is that when we get into the 1980s, financial planning actually started to become a profession. There were three different designations that existed, the CFP and the CHFC, and for those who came out of the accounting profession, the PFP designation. So there was a recognition that wealth management wasn't just about the money people made, but it was about the choices people made. Were they goals based? Were they cash flows based? Were there other issues that had to take root? Unfortunately, financial planning at that time was more of a come on. It was if we can assess where you are, then we can make recommendations, but the recommendations all tended to filter down to one thing. So if you're an insurance based financial planner, you tended to recommend insurance based products. If you're an investment based financial planner, you tended to recommend mutual funds or other packaged products. If you were a true financial planner, you were somewhat marginalized in the business because the economics weren't working. And in many cases, the early financial planners were pretty dogmatic about who they were, and there was an element of self-righteousness that oftentimes prevented many of them from making a profit and building a real business. So it was an interesting time when we saw that catalyst. Go ahead, Philip.
Mark, I would only jump in there that yes, CFPs emerged in the 70s, but it took 50 years to get to 100,000 CFPs, which we welcomed, last year. It took a long time to really take hold and grow within the space. In that sense, the planning driven nature in the 2000s, which you're about to get to, I think is interesting.
Yeah, it is interesting because financial planning, I mean, my wife and I work with a financial planner. We go through navigating different choices that we have to make. And it's not always a book of financial planning decisions. It's really more dynamic. And it's not just about can we afford to retire? It's what are the philanthropic decisions we're going to make? What are the tax planning decisions we're going to make? So it becomes more comprehensive and systematic in how we deal with it. So there's opportunity for growth, But what's also interesting in your comment, Philip, is that many people who have pursued financial planning as a career are often hired by the captive organizations and not by the independent financial planning firms. So the dynamic is truly interesting in how all of this is changing. But I think it is interesting how we see going into the 1990s how financial planning has become more dynamic. And as you pointed out in the 2000s, it became more real and there's more reporting on it. But we also saw this evolution of package solutions that changed the way in which advisors were implementing some of the programs for advisors. So ETFs became more robust, mutual funds became more significant. And in a way, we're going full circle with some of these products that people are using for investment management because, as we've been reading lately, the idea of using package solutions was it facilitated diversification of portfolios. And now, when we look at index funds, we're reading about the great overlap of index funds because there are just several stocks that seem to dominate those portfolios. So we'll see what that means for the profession going forward, but it does create an interesting new challenge. But to your point, I think that 2000 marked the growth of RIAs in the business from practices to businesses. This was a significant development because the profession of acting as a fiduciary advisor was really driven mostly by solo practitioners. And firms of 100 million were considered big. There were a very small number of firms that were managing over $1 billion of assets. And in fact, in many of those cases, they were tending to deal with the mass affluent or the high net worth clients. It wasn't really going up market as much as possible. But this change from practice to business was significant because it introduced a layer of complexity within these firms. We had individuals who were serving as advisors all of a sudden responsible for creating strategy, managing people, implementing technology plans, leveraging outsourcing solutions, and there's a parallel that we'll get to in a moment, but this happens in every single business that I've ever been exposed to, from Goodyear tire dealers to Hallmark card companies to auto distribution companies, to manufacturing companies, that you see these changes occur from fragmentation to consolidation to expansion. And there's this pattern that seems to be evolving currently at this point, where indeed technology is one of the drivers, but so is the business of financial advice moving to the enterprise of financial advice. And this notion of consolidation that's happening is significant. There's something like 65 private equity sponsors of consolidation. The amount of money these firms are raising is significant. It's significant for a number of reasons, not the least of which, for as long as I've been around the business, independent advisors have thought of their balance sheet as a cover page, not as insight into how they are funding their growth, making this distinction between funding it with debt or funding it with equity, and where equity comes from was not even part of the discussion. So the fact that a balance sheet is actually becoming fundamental to the management of financial services businesses is something new in this evolution. So the way in which we look at the data is going to be significant. As I
Mark,
mentioned,
before you
yeah.
move on, the technology-driven chapter that we find ourselves in right now, am I right to assume that that is partially driven by opportunity and partially by need? Here's what I mean. As we established earlier, the wealth creation in this country, the number of people entering the wealth management space as a client, the number of people wanting human advice continues to grow. At the same time, the supply side, the number of human advisors, is flat at best. In a way, technology must come to the rescue to allow the same number of advisors to serve more people, hopefully in even better ways. Is that fair?
I think it's fair because we're in a unique business. For those who are already in the business or contemplating coming into the business, what's unique about wealth management is there's an oversupply of prospective clients and there's an undersupply of providers. But the reality is there is a physical limit to the number of active client relationships any one advisor can provide. So two things have to happen. One is they have to create capacity by layering their practices with other humans, much like accounting firms or law firms do. And they have to be better at leveraging technology in order to do that. To the people I speak to who are far more knowledgeable about applications of technology in the wealth space than I am, what they generally say is that there are literally scores, if not hundreds, of technology solutions, but the usage of the capability of those technology solutions is limited. So now we have the introduction of AI, which has the potential to enhance the way in which firms function. But to the extent that we are seeing firms adopt AI, it seems to be controlled and measured, where there still is human supervision, because we're not sure where this will lead us. And there is always concern about the compliance risks within these firms. But it
Mark,
doesn't mean the combination won't help advisors to become more efficient and increase their capacity to serve clients.
that human limit that you point to, the number of people a advisor can serve well, would you also peg that at 150 or so, which is what I oftentimes see in studies?
It might be less. In fact, there was a study done by Julie Littlechild a number of years ago out of Canada that showed what she did in her data is she looked at how much time individuals spent with their high value relationships, with their medium value relationships, and low value relationships. I think the data has changed, but the premise has not. And what she found at the time was that the typical advisor was spending 20 hours a year with their high value relationships, 10 hours a year with their medium value relationships, and 5 hours a year with the low value relationships. So if you just want to do the math, um, um, in a normal professional's work life, they would spend 1,800 hours working. So let's just take the high value relationships of 20. If I divide 20 hours into 1,800, that tells me the maximum number of high value relationships I can manage is 90, right? So it's a pretty simple calculation. But this assumes that all the advisor is doing is working with clients. In reality, they're business developing, they're managing operations, they may have continuing education classes or master's classes that they're participating. So there are other things that suck up their time. It just begs the question, how are you going to free up your capacity when you have that physical limit?
Yeah, no doubt.
So add to that some of the catalysts for the evolution of the business over this period of time and what we see going forward is that even though for the most part the markets have provided some sense of fulfillment for clients these days, there still is a lot of stress in humans for reasons that uh, you can draw conclusions on your own. But what we find is that there is a concern among many clients, according to surveys, that the advisory firm they're working with may not necessarily be serving in their best interest. It doesn't mean that there is defection. It doesn't mean that there is a termination of the advisor relationships. But if something were to occur, like the sale of the business, that might cause people to defect to someone that they do trust. And in fact, according to the ensemble practice, what they're finding is in some of these mergers, there is as much as 5 to 8% attrition in clients post-merger. It may not happen instantly, but over 3 years, it might because of the fundamental changes that are occurring. So we have to be conscious and specific to our own businesses to say, uh, are we asking the right questions around trust and fulfillment and satisfaction? And are we dealing with the right things? Or are we only talking about investment performance or financial performance? If our tendency is to focus on what the market is doing instead of what the humans are doing, what the clients are doing, then we run the risk of instilling more distrust than confidence in that relationship.
Mark, let me ask you, given the historic theme of this conversation, that sobering perspective on client trust, do you have any view how that's been developing over time? Do we know if that's getting better, worse, or pretty much staying the same?
Uh, My sense, I can only give it anecdotal, but my sense is that there's growing wariness of large financial institutions, and so I would say that the level of trust and confidence seems to be um, mixed. And one of the reasons why I say that is because new platforms are being introduced for self-directed solutions, as an example. And so that would suggest to me that many individual clients might prefer to take control over their financial lives rather than entrust another individual. I mean, I've done random surveys among some of my golfing friends, and only a handful of them work with a professional, and many others who should be working because their lives are complicated, should be working with a professional, choose to do it on their own. It may be their own bias, but I think to me that indicates, if they're a doctor or a lawyer or an accountant and they're not hiring a professional for managing their wealth, there's something that's not ringing right for me in those cases.
Exactly, Mark. I would argue it's not binary, work with somebody or don't. There's something in the middle, the hybrid consumer that
Yeah.
works with an advisor for certain topics and is absolutely comfortable doing other topics in a self-directed way. That's certainly the case. Quick management call out here. Thank you for the questions that folks are feeling already. Remember to use the Q&A box at the bottom. We will be feeding those questions to Mark shortly. With that, Mark, back over to you.
Yeah, let me just hit on a few things just in the spirit of time that might provoke some discussion and will allow for this chat. I'd like you to think about going forward, after all that history, what we have to contemplate. We already talked about capacity as an issue within firms. That lack of capacity is also constraining growth. The average firm is growing X market at a rate below 5%. Consequently, profitability is lower because they're not gaining operating leverage the way they should. And in many cases, even though there are 200 universities around the country that are conferring either degrees or certificates in financial planning, we find that most firms are struggling to position themselves as an employer of choice. And so talent recruitment and development is becoming more of a challenge within these businesses. Some are finding the solution to growth in mergers and acquisitions. And I already talked to an extent about what this means if you're contemplating a merger. There are over 300 deals a year of firms consolidating. Broker dealers less so because there are fewer to do, but within the RA space, it's happening at great volumes. In many cases, it's triggered by the age demographics of the advisor. It's always one of those great surprises when they realize they're mortal, and so they have to transition. And generally speaking, we find the clients are of the same age or are older than the advisors themselves. So we have to be careful in our due diligence as to what the quality of those firms are. M&A does add talent. It does add capacity. It oftentimes adds a broader set of solutions, so it can be compelling. But in many cases, you may have passive investors, which may also influence the management decisions within the business.
And
When we
Mark,
look at
quick public service announcement here. Late last year, we had a speaker series event on M&A and wealth management. If folks are interested, they can
oh,
go on the Columbia website and find the recording there. It's obviously a big topic for our industry.
And what's interesting, as you think about it, is that M&A is not the only way to contemplate this. What ultimately all firms have to think about, whether they go through merger and acquisition or focus on organic growth, is are they clear about what business they're in? Are they clear about how their structure supports their strategy? Are they clear about their human capital plan and how this is aligned with the business vision? Are their processes becoming more efficient and effective? And are they generating the proper gross margins and net margins within the business that come as a result of good execution? So I think this is ultimately where we get to in the business, and maybe good time to open it up for questions. To what extent are people in this business open to change, or much as some people do with their investments, are they making decisions based on what something has done or what it will do? And with that in mind, why don't we open it up for questions and see if we can take it from there?
We will. Thank you to all that submitted so far. Please keep on submitting. Mark, let me push you though on what are the key trends that you see today that will shape our industry going forward? If you can synthesize them, from your remarks so far, what would those be? And then even more importantly, what's the so what? What are the implications for our audience, be it for mid-career advisors upping their game via a master's at Columbia, be it for transitioning folks from out of the industry into wealth management? What would be your advice for them?
The first is recognizing the change in client expectations. So, for everybody in this business, it's important to understand who your optimal client is. And there are a variety of ways in which you might get to that, including your own capabilities or how you might leverage your organization. But knowing what the expectations are of the client beyond investment performance really becomes a critical part of the trend that I think most firms are not locked into because they're competing with their competitors instead of focusing on the client side of the business. I think the second part is recognizing that new competitors are attracting business in different ways, and we alluded to this earlier. So to the extent that technology platforms become more compelling, this is a trend that we have to be conscious of. What if, for example, Amazon decides to come into the wealth management business? What if, and how they've disrupted so many other industries? What if some custodians are coming? Oh, I take that back. Some custodians are already in the business. Schwab and Fidelity are huge retail businesses, and they are competing with their advisor customers in that market. And almost every other custodian is trying to introduce a referral program, which implies they're already touching prospective customers of you. Third, a big trend is on the development of talent, that having people come out of university and go straight into the business and expected to grow the business is unrealistic because it may not align with the strategy. And we know that there is this cross between energy and wisdom, that the older you get, the more your energy wanes, but the more your wisdom grows. In the beginning, all you have is energy, and we have to think about what this implication is for people. And then the third or the fourth point here that I would say is a big trend is how will you redefine success in terms of the client relationship? What kind of impact will advisors make on their clients, and how will clients value that? Because this is all ultimately going to be reflected in the price they pay and the way in which they build a relationship with you. Right now, this is the only industry I know where clients pay for the value they bring, not the value that the advisor brings. It's like my doctor charging me by the pound. At what point will I be overpaying? And so we have to be thinking about this going forward in the business.
Excellent. Very helpful indeed. With that, let's turn to some wonderful audience questions. Kayla is wondering, what does it take, Mark, to attract the next generation of advisors into our space? What are they looking for? And what do we need to provide more of to attract them?
First off is whether or not there is a clear path for growth. Some will say that compensation is the driver, but that compensation is used as a driver absent any other thing. And so what they do expect is fair reward for what they're doing, and ultimately the opportunity to not just get a reward for their labor, but a reward for ownership. Second, they want to know that they're going to be mentored and developed and guided in a way that allows them to achieve personal and professional fulfillment in the way the founders have achieved it. It doesn't mean they're not self-driven, But the advantage of working with organizations that have experienced leaders is they can learn from those teachers in ways that not all advisors have committed to. Third is it's a business that's well regarded, well respected, and that has opportunities for growth in itself, and possibly even have the opportunity to be recognized as one of the leading firms in their market, however you define that. So those are some of the elements that we see around what causes people to go to one firm or another.
Excellent. That also covers, I think, the question someone else had about what makes an employer of choice. So thank you for covering that. We have a very specific one that I'm going to read out verbatim to be of most help, to the person asking. Given how the industry is evolving, where do you see the best entry points for career transitioners who want to grow into advising or planning roles? Would you recommend traditional entry-level roles, apprenticeships, or any alternatives?
Well, there's never a perfect solution, but I think that the first question is, what do you bring to a firm besides a lack of knowledge of financial advice? And chances are, if you're a career changer, there's something in your background or your experience that has teed you up for a natural transition. It could be the way in which you engage with people, could be a technical skill, maybe an aptitude for learning, maybe a knowledge of a certain industry or profession that complements how the firm is growing. So generally speaking, when I look at the best managed advisory firms, I find that there is a career ladder where there's probably going to be 5 or 6 tiers where one could enter. I would say that career changers don't necessarily have to enter at the bottom, or if they enter at the bottom, the question is, what are the measures that will allow them to move up the rungs of that ladder? And what's the timing that that will occur? And what will be the guide provided in order to get to there? So I think for career changers, it's a great question, but I wouldn't assume that you necessarily have to begin at the beginning. But you also have to think about what value you're bringing to the firm so that it's not just a job change, but it's a way in which you want to make a different impact.
Mark, you mentioned the Kitces and Carl podcast earlier, and Carl is the guy with the Sharpie. He, draws a lot. He's a very visual guy, and
Yeah.
he likes to use overlapping Venn diagrams, two circles. And I'm reminded here, perhaps the answer is view it as two circles. What do firms need? And what do you bring to the table? And where the two overlap, that's potentially a sweet spot.
Actually, the two that I would use would be two that I alluded to earlier, is that what firms need is more energy and more wisdom. And so we know that the founders may have wisdom, but they may also have a death grip on the management of those client relationships. And so they have to expand that circle to get more informed people as part of the business. Uh, the founders may have a lack of energy, though. And so the question is, how do they get more drivers in the business in order to propel the business forward?
Always company specific for sure. I want to get two more questions in before we wrap, two great ones. One is around convergence. Christine is asking, advisors are being asked to do ever more. The convergence of health and wealth, tax planning, family governance. There are more and more topics being brought up in the client advisor relationship. How is one to manage the breadth of all those topics as a person with a finite, personal computing power?
Well, I love the question, and that probably goes to the point of saying that you have to think beyond a one-person advice team. That this is where leveraging your business really creates a breadth of offering. But you have to be careful not to just be one-off in delivering advice. I think this is where many advisory firms get over-diversified, is they deliver too many things. It's like if I asked you to manage my portfolio and you have 1,000 different positions, that's an over-diversified portfolio. In this case, how do you concentrate around your core client? That said, I think for when we look at the future, this triple squeeze between managing the needs of your parents or your grandparents as they age and and have higher healthcare issues, and managing the needs of your children or dependents becomes a critical part of what's happening. I mean, children are living at home longer, and parents are living out their lives longer. I think about this in my own case. When my parents retired, they didn't have much. I helped subsidize them for over 30 years in their retirement, and the last 10 years in assisted living for my stepmother. And that was something they were not prepared for, nor was I prepared for. But it was something we had to manage. And if we'd have thought about it earlier, there probably would be different ways in which to gear up. So looking at your optimal client and what are the most common needs is where I would tend to focus. Decide what you want to own and decide what you want to rent because you're not going to be able to do everything.
Excellent. I want to end with a question from a former BNY employee who's wondering, what are your thoughts on advice-only type of planners? We established earlier that there's so many different business models, regulatory regimes, and ways of getting compensated and ways of creating value in our industry. Your thoughts on advice-only type of planners? What future do you see for them?
I assume what that question means is people who are just doing financial planning and not executing on investment strategies. Well, there are quite a few people who are functioning within that role right now, where that is exactly the business they're in. I think that one of the challenges is being able to demonstrate to the marketplace that this is a true value. I think some refinement in the way in which it's positioned, the decisions that one is helping clients to navigate, and what your systematic reporting is going to look like so that you're demonstrating value on some consistent basis. I think generally this is a gap within all advisory firms, frankly, is that the only reports we get are investment performance when they claim to be doing so much more. And I surely would like to see technology do a far better job of creating a fuller profile of how I'm progressing in the decisions I'm making. A good example of this is that if one of my priorities is philanthropy, how are you evaluating this beyond the tax savings? What impact am I making? Am I focused in my philanthropy? How will I implement this over time? So you can take any subject and think about that in those terms.
Mark, different profiles have had success in our industry in a variety of roles. There's a late breaking question here that I want to weave in because I sympathize so much. I know that so much of this business is about prospecting and relationship building. Do you have any advice or success story for true introverts? How can they succeed in our space?
Well, the best example I can give you is that I was a partner in an accounting firm, and an extroverted accountant was somebody who looked at your shoes. But this was a firm that was filled with accountants that were able to develop business. And why were they able to do it? Because they were clear about their optimal client, they were clear about the needs of their optimal client, and they were able to communicate this with anybody they encountered. So I think this evolution from prospecting to branding to becoming more visible using good social media techniques and other technology techniques is one way in which to deal with this. Meg Carpenter at FICOM has some great solutions around this that's worth checking out to help you think about using available tools to extend your brand, but be prepared to respond to opportunities wherever you're engaging with prospective clients.
Meg, I believe, is a PR expert, and FICON is the name of the firm, right?
FICOM, COMM. Yep.
Wonderful. Great resource. Great tip. Thank you for that. Mark, we're at the appointed hour. We could go on, but we need to wrap this up.
Thank you.
Thank you on behalf of Columbia University, our students, and the entire audience for sharing your wisdom and perspectives on our past, present, and future. I
Thank you.
hope that the audience got as much value, food for thought, and tangible tips out of this conversation as I did. Mark, view yourself as a friend of Columbia. Next time you're in New York City, give us a heads up. We'd love to tour you on our beautiful campus. And with that, it's a wrap. Thank you, everybody.
Thank you.